Welcome back to Intelligent Investment Today, the podcast concerned about all things value investment. In each episode, we look at a different topic using the laws of value investment as laid down by the man considered to be the father of the craft, Benjamin Graham. Each instalment acts as a building block in a journey to becoming competent in the craft. Whilst it is understood that different listeners will be at different stages on this journey, ranging from those right at the beginning of the voyage to those who are already successfully implementing value investment in their day-to-day decisions, I hope there'll be plenty of interesting and thought-provoking material for all. In today's episode, we consider another interesting aspect of value investment. That is the sometimes thorny issue of share buybacks or repurchases. This is a process where businesses decide to reinvest profits generated by the business into buying stock in their own company. We shall consider the pros and cons of doing so and hopefully arrive at a satisfactory conclusion. So buckle up, sit back and get ready to digest another healthy bite of value investment the Benjamin Graham way. One of the reasons I find the topic of share buybacks so interesting is because it is one of the issues on which Warren Buffett and his mentor, Benjamin Graham, disagree so strongly. It will come as no surprise for anyone who has followed Berkshire Hathaway over the years that Buffett is something of a superfan of reinvesting profits back into the business through share buybacks. Their policy of not paying dividends means that they frequently buy back stock of their own company. Buybacks have the effect of reducing the total amount of outstanding stock in circulation, which of course means, in theory at least, the stock price for the remaining shares should rise. This can be advantageous for stockholders in a number of ways. Firstly, the presumption is that the business is purchasing stock that they consider to be undervalued, and which should ultimately compound to the benefit of the existing owners of the business. And secondly, there may be benefits for the shareholder by not instead paying out these excess profits in dividends that could result in a tax liability. So what's not to like about share buybacks? It all sounds pretty wholesome, right? Well, Graham had a number of concerns on this front, and either Warren Buffett skipped that particular class or decided Berkshire Hathaway was a special case. Graham's first issue with stock buybacks was a moral and rather abstract one. He worried that it was improper of a management team to tempt the owners of that business into selling their stock back to the company if they believed the stock was underpriced. Management could also quite feasibly engage in dark arts to the detriment of those who sell out in order to benefit those who hold on. They could falsely lower investor expectations, which would then allow them to buy back shares at an unduly low rate. This might turn out well for those who hold on, but those who have sold out may rightfully feel aggrieved that they have been misled by the people they were paying to run their business. Essentially, Graham thought this amounted to ripping off the owners of the business. On this, I think Graham has a point, but I also believe that Graham lived in a more chivalrous time on the stock market, where the world of investment occupied a far smaller space, and gentlemanly conduct was the expectation, if only for the reason that what goes around comes around. I think we all now realise that we live in a dog-eat-dog world, where other investors are both faceless and inanimate. Graham's main issue with share buybacks, however, was a far more concrete one. He worried that management teams could not always be expected to act in the best interests of even those shareholders who do hold on. Oftentimes, management teams are incentivised through the promise of bonuses that are tied to the stock price. If the executive bonus package is tied to the stock price reaching a certain point, as it often is, it is surely too much to expect of the management team not to use the tools at their disposal to engineer the price to the level required to meet that target and to trigger their multi-million-pound bonuses. If that means buying back shares at levels they know do not offer ultimate value for the shareholder in order to meet these targets, then so be it. It was for these reasons that Graham had grave objections to the implementation of share buybacks. His concerns were especially prescient due to the fact that in enforcing share buybacks, they are only bestowing a benefit that is already open and available to the investor. For that investor, through use of their dividend payment, can already choose to buy more shares in that business if they wish, should they believe the price is unduly low. The management, through the enforced reinvestment of their funds, are therefore only taking away the individual investor's choice in whether they wish to reinvest more funds in that business or take their profits for investment elsewhere. It must be stated firmly that Warren Buffett has done especially well for his investors at Berkshire Hathaway in the past by using his investors' profits to buy back stock in the business. Buffett, however, is an unusual case, for he is not motivated through bonus schemes to manipulate the share price in this way. It would of course still be possible for him to personally benefit along with other shareholders who hold on through distorting expectations for the business, thus lowering the stock price and giving him the opportunity to then buy them back at low levels. But I think we all know of Buffett that he's a pretty straight sort of guy, so there is that level of trust there. But we cannot honestly expect to know the management of other businesses as well as we know the most famous investor on the planet. So what are my final thoughts on share buybacks? It might not surprise you to know that I am very much against them, and as a value investor, I think you should be too. Value investors make investments on the basis of their own calculations, that a business offers value based upon the difference between the valuation that they have arrived at and the price the business is trading at. By retaining earnings that rightfully belong to the shareholder and buying back shares in their own business, management teams are taking away the right of the value investor to come to their own conclusions as to whether the price they are paying offers good value. By distributing earnings through dividends, the value investor has the option of buying back shares in that business if that is where the best value lies, or taking their money elsewhere if it does not. And that's all, folks, as a stammering pig once said. I hope you've enjoyed the episode, and even if you don't agree with my strong opinions on share buybacks, it has at least provided some food for thought. Please do consider adding us to your playlist. That way you'll be alerted as soon as new additions land on your platform. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.